The Queen of QT wants higher yields. Can she do it? And why does she even want it? Small businesses are complaining they can't get enough employees, but are actually hiring those who apply. And consumer credit hits a new all-time high. All that and more on today's Macro Show. I'm your host, Steven Van Metre. Thanks for joining me today. And let's get right into our headline story. Former Fed chair, now Treasury Secretary Janet Yellen, is calling for higher yields. And I want to remind you that under her tenure as Fed chair, there's a reason I called her the Queen of QT, is because she's the one that brought the federal funds rate off of the zero interest rate policy, and she's the one that started quantitative tightening. Of course, we know how long that lasted because Jerome Powell reversed that in late 2019. So it just goes to show that she didn't get much mileage out of her rate hike cycle. But now she's back in the position as the Treasury Secretary calling for higher yields. What's going on with that? Well, here's an article on CNBC. Higher interest rates would be good for the country, Treasury Secretary Yellen says. Former Fed chair said the president's plans would total about $400 billion each year of spending. And she said if we ended up with a slightly higher interest rate environment, it would actually be a plus for society's point of view. I don't know about that, but I do agree. And she says the Fed's point of view. Let's look at see if what highlights we have in here. She says we've been fighting inflation that's too low and interest rates that are too low now for a decade. And despite her actual attempts to get them higher, as I mentioned, by raising the funds rate and quantitative tightening, it didn't work. She added that if packages help at all to alleviate things, then it's not a bad thing. That's a good thing. Now she's referring to the stimulus packages here. So here's the first question is, as the Treasury Secretary, can she get interest rates to go up? The answer is no. She does not have such authority. Her job is to manage the debt of our country. If we really wanted to get higher interest rates, from her standpoint, then she would convince the Biden administration and Congress to spend less money and run a surplus. You want to get interest rates up? Start running a surplus and you'll get higher rates. Now the question then is, why does she want them? Is it because she just likes higher interest rates? Is she short the bond market? Well, and she did say it would be good for the Fed. Now this is true, because if we were to slip into a recession, which we actually still are in, what does the Fed have to do? They have to lower yields, right? They have to lower rates. So can the Fed lower the federal funds rate below zero? Nope, they can't. They're stuck. They've got a 0 to 0.25. That's as far as they can go. So what will the Fed do to get interest rates to go lower? Lots more quantitative easing. So what she's saying from the Fed standpoint, which makes a lot of sense because she is a former Fed chair, is, man, it'd be really nice for rates to go up a bit to give the Fed some margin for error in case we are still in a recession or this whole thing rolls over, which it's going to. She probably knows it, but she's got to be hopeful here. How about to validate economic growth? We've talked about this on the Macro Show, that if you're going to see higher stock prices, you're going to see an expanding economy. What you're going to get with that is higher interest rates. So at this point, higher interest rates would validate the economy is coming out of its slump. How about to confirm that inflation may hold? A lot of people think that inflation then drives interest rates up. It's really interest rates that are going to keep inflation higher, because how do you get higher interest rates? Through an expansion of money. So you need borrowing, you need lending. And on that note, well, it would be good for the banks too, which she used to work with considerably and probably still does to quite some degree now as a Treasury Secretary, is banks would want to lend money, and higher interest rates are better for them. And what we didn't cover on Friday's show, the PowerPoint slides, because you can just see how bad things are from a lending perspective. You look at real estate loan growth rate is up to negative 1.05% from a year ago. So from this time last year, we're seeing a contraction in real estate lending growth. That's not how you create money. You want to create money, you need to see this going up. And yet the 3-month rate of change is negative and falling. Here you see in red, you see the 30-year fixed rate mortgage yield, and it's telling you it needs to go down. It needs to go down. You can see all through here. You see a contraction under this where the blue was in contraction. And while it was coming out of the contraction and going level here in 2012 to 14, it still needed lower rates to do that. And then to get this boom up here, rates had to go down again. So where do you think rates are going for mortgages? They're going lower. How about commercial industrial loans? Well, remember, this thing shot up due to the pandemic, and now it's shot down just as I said it likely would. And now you have a dangerous situation because the 3-month rate of change is running at minus 3%. So there's a massive contraction in commercial industrial loans as debts from large companies are getting paid off. How about total loans and leases? Now let's take everything, consumer, real estate, commercial, industrial, let's just take it all together, and you've got a growth rate contracting at 4% from a year ago. That's money destruction, not money creation. So while Janet Yellen's calling for higher rates, the market's screaming rates are too high. And even the consumer, looking at credit card growth rate, and we're going to look more at the consumer credit data here in a little bit, it's up to minus 2.07% from a year ago. So even from a year ago, consumers are paying down their credit cards. Now, do you think for a moment, and I want you to think about this, what will it take to get consumers to spend or to charge more money, to borrow more money? Is it going to be higher interest rates or lower interest rates? I mean, are you sitting here thinking, man, I can't wait to buy a house, but it would be great if interest rates went way up? Well, what if you knew the principal value is going to come down? The answer is rates need to go down to spur credit growth. That's a problem, and we're seeing in the data that rates are too high. So she is right from multiple perspectives. It would be great if interest rates went up, but they're not going to because they can't. We're seeing a credit contraction, and while you can get a transitory increase in rates, they will not hold. Let's take a look now at what's going on with the jobs data. Well, we've got a report from the National Federation of Independent Businesses, a small business jobs report, and this thing is really, really interesting. So check this out. This is their May jobs report. A record high, 48% of small business owners in May reported unfilled job openings. Shocking, right? We know that. We know they're saying, hey, we got all these job openings. And it's the 4th consecutive month of record high readings for unfilled job openings. And that's crazy, right? And businesses, small businesses are saying, quote, owners are struggling at record levels to get workers back in open positions. They're offering higher wages to remedy the labor shortage problem, but ultimately those higher costs are going to be passed on, if they're not already being passed on, to customers who actually will not be able to support them. I'm adding that part there for you. But check this out. Let's see, 61% of owners reported hiring here's the key, trying to hire in May. I want to focus on this trying to hire part because this is where it gets interesting. Small business owners continue to report finding qualified employees remains a problem, with 93% of owners hiring or trying to hire. So again, now we get this trying to hire after we started this unable. Remember, started out with unable to fill positions. This should be titled, as you'll see in a minute, don't want to fill the positions or can't. So 93% of small business owners saying, look, I can't find qualified people to hire. And yet you come down here and look at this graph. Can small businesses hire enough workers? Look, their percentage with at least one unfilled opening, just bam, high as it's been since January 2010. Are they hiring workers? Now, this is probably the most interesting chart here. And if you're out looking for a job or going to be looking for one, take note of this. Are small businesses hiring? The average change in employment per firm going back to January 2010 through May 2021. And you can see workers per firm, there's a 0 bar here. So the average change you can see between, say, 2010 and 18-ish, 2017, it was largely unchanged. There really wasn't much. They'd hire, they'd fire, hire, and fire, hire, and fire. Look at it. Here's the pandemic, big drop, workers left. They came back, and now, as of May, they're shrinking employment. So this headline makes no sense. They're unable to fill. No, the truth is they're not hiring. They're trying to hire, but they're not. So the question then becomes is, how long will this trying to hire turn into not hire? Because the advantage a small business owner has if they're not hiring right now is they know the stimulus is going away. They know it's not being spent. They know the bulk of what's going to be spent has been spent, and what's going to happen to demand, right? Where's our bearish arrow? Demand goes down. Don't need as many employees. So it's kind of weird. You see in this data that, oh, I want to hire, but not you, not you, not you, not you, none of you. I mean, they're not even training people. Kind of odd to me. Let's get back into some of the economic data. We have the Conference Board Employment Trends Index is shooting back up. Now, this is a positive sign. And what is this? This is also from a multiple number of statistics. Response to saying jobs are hard to get. Initial claims for unemployment, percentage of firms with positions not able to fill. So they're looking at a number of different things. This rising, and you can see going back number of years, from recession lows and up. So this rising is a good sign for the labor market. It says there's job openings out there, and this should be considered a good indicator, except you just saw from the same people that provide some of the data for this report that they're trying real hard not to hire. How about consumer credit, now at a record high? Now, we did look at the commercial bank lending data, but now we're going to look at consumer credit specifically. Total rate of change up 5.3% in April. Going back in 2020 and see a negative 0.2, a plus 0.6, minus 5.6, 1.9. So you see very little credit growth here. So 5.3 is nice. We have 3 months in a row over 5. That's positive. What's interesting is revolving or credit card debt went down. But we knew that because we just looked at the credit card data. Non-revolving is up 7.6%. You say, well, what's non-revolving? Well, that would include motor vehicle loans, which we know there's a big demand for cars, been a big demand, and all other loans, not including revolving credit, such as loans for mobile homes, education, so student loans, boats, trailers, or vacations. And so there we see consumers now at a new high in debt. Let's take a look at the commitment traders, see how hedge fund managers are positioned in the futures market. And what we see here is, what are we looking for? I suppose that would be a good question. What are we looking for? Because everyone's really bullish on, they're saying yields are going, where's my up arrow? Up, right? That's the view. But when you look at speculative positioning, you're going to see something a little different, because it's not until the speculators are very long, so here on the 10-year, way up here, and they're just down here, that you start to get a bottom in interest rates. So until speculators are flushed out of their shorts or their shallow longs, you're not going to see that. And on the 30-year, you're seeing they're still rather short. They got a long ways to go to get way up into this zone up here to indicate that, yes, yields are at a high. And we can turn to our friend Stefan from Skyway Asset Management. He sends us some charts this week. TLT, which is the iShares 20-plus Treasury year bond fund. Talk about that right at the end of the show. Net commercial futures, non-commercial futures. So this is speculative positioning. What we're seeing here from Hedgeopia, just in maybe a little bit easier format with TLT above here. And you're seeing the speculative position, short positions come off. When that has happened in the past, you can see right here, it led to a rally in price. You can see it right here, leads to a rally in price. See it right here, leads to a rally in price. So this is now becoming consistent with a rally in price. He also sends us the total net positioning from TLT against 2, 5, 10, and 30. And this is looking at all positions. He's showing us 2-year remains net short. 5-year total is long. So people are long the 5-year auction, even though we've talked about how there isn't a big demand for auction at the 5-year, but people are long that. They're long the 10-year, quite long. The total positioning is net long, and even net long the 30-year, which all supports his position that when you look at the total net positioning, when you see these big long positions, you're going to see a rally from here, even as the longs get worked off into shorts. You can absolutely see a rally here. And so that, again, from our friend Stefan at Skyway, we appreciate that. Let's take a look at anything else here in the hedge fund positioning that we're overly interested in. And yes, the euro, because a lot of you are very bullish on gold. A lot of people are bullish gold. And here you see euro positionings are still increasing. So if you're bullish on gold, bearish on the dollar, then this would support that view. And if we look at gold positioning, virtually unchanged, but that push higher in the euro, which is a big portion of trade weighted dollar, is very helpful to anyone who's bullish on gold. In fact, if we look at the dollar, you can see here virtually unchanged. Now, one thing that is interesting, speculators are fairly short the Russell 2000, which is getting crushed by meme stocks right now, your AMC and GameStop. And the speculators are really unchanged in their volatility position. So quite confident, they're quite confident that volatility is not about to erupt. Now let's take a look at what's going on with TLT, and we'll wrap up, because if you've been following the story now, on last Thursday, we talked about the Wyckoff bottom almost being complete. We've been looking at the momentum not only on this Sunday night chart show from this week, but the week before. And now look what's happened today. What you can see is here's this big volume profile line sitting at 139.58. TLT closed at 139.47. So it's in this heavy zone of trading volume over the last 6 months. Think of this like walking through molasses, or when I was younger, I went canoeing up in Canada, and we got deviated from our course and ended up kind of walking, carrying canoes and packs through what was meant to be a portage, but it was a really swampy lake, and you're talking knee-high mud, and you're slugging through. That's what all this volume is like. It's exhausting for the sellers, because there's all these buyers have been sitting. There's no one left to really sell and to help sell. So this is a positive indicator supporting a near-term breakout coming in TLT. And for that, we'll close the show with the crown on. Again, thanks for being fans. Thanks for supporting the show. Wouldn't be here if it wasn't for you. We'll be back, of course, on Wednesday. I know there's some exciting data coming up. We got CPI, I think, and some other cool stuff. We'll see how the market reacts to all that. I'll see you then. Thanks for watching. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It chose not to be construed as a recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.